Welcome to our 2023 mid-year review and outlook for the remainder of this year, as well as for the next 12 months. I am Katrina Radenberg, and I'm the Chief Investment Officer for Mariner Wealth Advisors. And with me today is my colleague, Jeff Krumpelman, our Chief Investment Strategist and Head of Equities. Jeff, thanks for joining.
Thanks for having me on here, Katrina.
Excited to do this. We have some great dialogue prepared for this afternoon, but before we jump into that, I'm going to give a quick overview of what's transpired since we were together in January doing our crystal ball outlook for the year. It's hard to believe 6 months has already gone by. But as we go through the review, for starters, it's just hard to come up with a phrase to describe the first 6 months of 2023 other than wow. And wow in the most positive sense. The S&P 500 advanced over 16% year to date through June 30th, and by 24% off of the October 12th, 2022 closing price low, when bearish predictions in the media and by many peers were rampant. Skeptics were declaring the risk of long duration tech stocks and warning to avoid them like the plague. Fortunately, we kept our heads down and focused on the facts as the tech-heavy NASDAQ advanced over 30% in the first 2 quarters of 2023 and produced its best results in more than 4 decades going back to 1980. We are pleased we suggested investors not abandon high-quality growth stocks within technology and to maintain a blend of growth and value, even though many experts were suggesting to shift to more cyclical value stocks that were the outperformers that we saw in 2022. The economic data and associated financial market metrics trended well and improved throughout the period. As we thought, the challenges at Silicon Valley Bank and several other select banks in March were handled skillfully by government regulatory agencies and did not lead to a broad credit meltdown that some had feared back in that time period. The debt ceiling debate was adequately resolved, as has been the tradition on a regular basis for the last 4 decades, and as we anticipated, even if it was in the 11th hour. Inflation continued to trend in a less worse fashion and calmed in a manner consistent with our expectations, allowing the Fed to begin to signal that much of its work is complete. It is true that they have raised rates swiftly and significantly, but only back to normal or average levels on a historical basis. They may employ a couple more 25 basis point rate hikes, but they do appear to be in the 8th or 9th inning of their monthly policy adjustments, and again, have not taken us to restrictive levels. Last but not least on the skeptics' list of reasons to be bearish, many have emphasized the narrow leadership in the S&P 500 and pointed to this as a sign that doom and gloom is right around the corner, and as evidence that the advance this year is not to be trusted. In fact, those making this argument have implied that only the largest 8 stocks in the S&P 500 are in positive territory this year, and the other 492 stocks have underperformed. This simply is not true. The market move was far broader than appreciated earlier in the year, in our view, with quite a few stocks and industry groups performing well and contributing to strong S&P 500 returns. Further, leadership did broaden significantly in both May and June, with all 11 S&P 500 sectors in positive territory in June. The equal weight S&P 500 index outperformed the market cap weighted index, and industrial stocks have shown strong performance. So it wasn't just a handful of the largest tech stocks doing well while all else suffered. Once again, naysayers jumped immediately to worst case outcomes on these various wall of worry issues, while market returns ended up being better than feared. Finally, what about that recession that was supposed to arrive in 2022 or 2023, or now potentially 2024? The data suggests clearly that if we do finally have one, it should be of a soft or mild variety. as important, the economic and earnings data was revised upward as we closed out the first half. Employment payroll numbers remained solid. Real GDP growth for Q1 was revised up from 1.3% to 2%. Consumer confidence improved in the latest data, and S&P 500 earnings growth and profit margins are stabilizing and beginning to improve. These are all reassuring signs to us that this rally is real. So Jeff, let me bring you in at this point. I'm establishing a fairly positive tone as we kick off this discussion, which I'm very happy about. So how am I doing? Do you agree? I have a feeling that I might already know your answer.
Yeah, I think you do know the answer. And yeah, I love the tone. And I absolutely agree with what you're saying, Katrina. And if you cut through all the interesting detail and the metrics that you went through, you're simply saying, as we thought, that the various wall of worry items on investors' minds, they were solved or they evolved in better than feared fashion, that the fundamentals, the valuation levels, and the technical price trends are relatively constructive. And that's so despite all the dire prognostications in the bear camp. And as a result, the market cheered. And hence we got this really nice rally in the first half and off the October 22 low. And it's really not more complicated than that. So kudos to you. That's a great summary. And I think, we would believe, or we do believe, that we promoted a productive message during the sell-off in 2022 and throughout this early recovery in 2023. And we hope that our audience today and the broader client group that we work with, that they agree. And for our part, we recommended that clients pare back their stock allocation to their normal long-term target beginning in January of 22, not 23, but beginning in 22, if you recall, if the robust returns of the prior 3 years, 19, 20, and 21, had taken their stock exposure to well above normal. And if they did nothing, it had done that. It had taken it to well above normal. So we have suggested holding your ground at this normal, or what we call the neutral stock exposure level. And we maintained a price target of 4,500 on the S&P 500 in a base case by year end, based upon our assessments of the fundamentals of the economy and the capital markets, based upon stock valuation and what we saw in technical price trends. But we saw upside to maybe 4,800 by the end of this year if everything fell into kind of perfect place with trend and inflation and where the Fed would stop and so on and so forth. And to put that in perspective, we're right around 55, or sorry, not 55, 45.
Ooh, that'd be good, wouldn't it?
It would be good. I think that'd be a little scary, but I'll calm down. We're at 45.50. As we speak right now, we have exceeded what our base case expectation is by year end. But we still believe that if we continue to trend positively, we can get a little multiple expansion on decent earnings, and that could take us to 4,800 by year. And then we're going to extend in just a minute, talk about the next 12 months and where we see the trend, longer term. But, the bear camp had just become uber negative going into 2023. And while we didn't see a rocket ship to 4,500, we thought there would be some volatility and maybe some real nervousness. We remained constructive on where we thought we were headed. We embraced a more moderate view about resolution on the wall worry items like debt ceiling and what's going on, in the banking world, with calming in inflation and with what the Fed would do. We just felt like it would not be worst case, and the bear camp was just jumping to worst case, and we're going to have a big recession and all that kind of stuff. So we're pleased with the less than worst trend in the data and on these wall of worry items, and glad that a more moderate tone did prevail, and that really supported and continues to play out. Our positive thesis of 2023 continues to play out. It's not perfect, but it's way better than feared.
Yeah. So clearly, we both agree that the first 6 months were not just profitable, but that the advance is warranted based on the underlying catalysts and metrics. So before we dive deeper into this, why don't you recap our major themes that we laid out back in January and what we got right versus wrong upon reflecting on the results and the events of the last 6 months?
Sure. So,
Well,
you see on this slide, what we got right versus what we missed. And on the what we got right side of the ledger, we maintained this positive longer term view on the S&P 500. Again, we didn't think the sizable amount of allocation or exposure to equities. We also had a strong message not to abandon growth stocks. There were so many people beginning in 2022 that say, hey, you need to run to value. Abandon these quote unquote long duration growth stocks, because when rates rise, these things get killed. And they did sell off, rather significantly last year and underperform relative to value last year. But we felt like it was important to hold your ground there as well and maintain balance. And boy, are we glad we did. You got the NASDAQ up, the tech-laden NASDAQ up 32% so far through June of this year, versus about 17% for the S&P 500, so almost double the return. You've seen wonderful returns in consumer discretionary stocks that tend to be more growth oriented. And we actually not only held our ground there, but in our internal equity strategies, we increased our exposure to growth. And we're really glad we did. And those strategies where we did that, we have well outperformed. Rates we thought would stabilize and trade in a narrow range in that 3 to 4% kind of territory. And they did. And bonds, as a result, were effective diversifiers, and they generated some good income. And, I talk about my 97-year-old mother, who is just an icon. I can't believe how engaged she is in the world and youthful. But, she's really happy now. And will actually claim me as, a family member, that rates have gone back to 5%, and that we can go out to some nice, restaurants rather than just going to Bob Evans all the time, now that rates have gone up to, 5% in her money market. So, that was something that we thought. We didn't see rates going to 6.5% or something that folks feared. When the 10-year rises above 5%, that begins to be a little bit of a headwind for the market, and we've stayed, kind of below that and stabilized. And we've had better than feared outcomes on all these key wall worry items. And so I think that we kept, a kind of a measured view on these challenges, and they've been handled fairly well. Now, what we missed is on the right-hand side, and I'm glad it's a little shorter than what's on the left. We were surprised by the strength of the rally in the first half. So I just said our base case was 4,500 for the year, and we're there, right now. So, that is something that we probably expected, a volatile, but still positively trending first half, but a lot of return to come in the second half. We've already gotten it. We were surprised by the persistent negative rhetoric from the Fed, and that did keep the market, as soon as you would get a run for a bit in the first couple quarters, then all of a sudden Jerome Powell would speak and it would sell off. And we did think that it would be temporary, because the market would look through whatever he was saying in his speeches and press conferences and see the very resilient U.S. economy and earnings pattern, and that would prevail. But, really have been surprised that the Fed has continued to say, dang it, we're going to keep after these rates, and we're going to, beat inflation down. They're winning. And we think that they can cool the rhetoric a little bit. And we do think that they're in the ninth inning here. But, that was a little bit annoying on our part. We don't judge what they do, but it was a little annoying. And then finally, the magnitude of the outperformance of these mega 8 that you talk about. We have exposure to them, and we've been able to do well in our internal strategies, despite the fact that we own them equally to their representation in the S&P 500, or maybe we're a little underweight because we've had some good selection outside of that, but we would have thought that the market would have been a little broader, a little earlier. It's broadened out nicely, as you say. Other stocks have done well, and that's underappreciated. But we were surprised that, it was the Amazons and the Facebooks or Metas and, the Nvidias and all those stocks that really did super well. We didn't necessarily see that.
Yeah. Well, I would say if the worst we can say is that our biggest mistake was underestimating the strength of the market, things aren't too bad. And I think our clients can probably live with that also. So let's shift from past to present and future. Why don't you update us on our outlook for stocks over the next 6 to 12 months?
Yeah. So, we do that. This is crystal ball time. And, if you only had to select one slide, this could be it. And it can, and I'm sure will be used against us if it doesn't move in our direction. But, we don't paint ourselves in the corner here. We have 4 different potential scenarios that we see playing out over the next 12 months. So this is June 30 of this year through June 30 of 2024. And over the next 12 months, we assign a 60% probability in that green to an S&P 500 level of 4,800, which is about 8% above where we're at now. And if you include the dividend, you get about a 10% return, which is, right on that average. And that would put us back above the January 2022 high of 47.96. So we would have recouped that. And boy, does that feel a lot better than the 35.50 that we saw in October of 22, right? That's a significant kind of run. Mm-hmm. And it's not all that challenging, I don't think, to get there. That's really looking at next 12 months earnings of 260-ish and assigning an 18.5 multiple, which is about where we're at on the S&P right now. And some people will say, boy, 18 sure does sound high. Well, I've seen stock market valuation stay at double-digit levels as long as the fundamentals and the technical trends look, pretty solid as they do. And I would also say that it's interesting. We find comfort in that those mega 8 that we mentioned, the Microsofts, the Amazons, the Metas, the Nvidias, and so on and so forth, those just 8 names, they're trading at over 30 times earnings. The rest of the market, the other 492, are trading at 15 times. So we think it's very possible that you might see some shrinkage in the PEs of some of those larger names, but you could get expansion because the average PE over the last 5 to 10 years has been something like 17. So they stand at below average. And so we do think that you can hold the multiple on the S&P 500 if the trends in inflation continue to be good, to calm. We think there's a 10% probability that we get some upside here that takes us to nice double-digit territory, 5,000 on the S&P 500. And what would do that? Well, I think if the Fed does stop after their next meeting and inflation continues to calm and we don't have this recession everyone's talking about and has been talking about for a year and a half, that you could get modest multiple expansion to 19 times. You hit that consensus earnings of 260. And all of a sudden you're at 5,000. And that would really be nice, wouldn't it? Now, we also can see that there could be disappointment. And, what would happen? Well, in that case, 20% probability to the market selling off to the 3,900 level. That would happen if inflation was a little stickier than we thought, the Fed was a little crabbier than we thought, and they didn't stop the rhetoric. And maybe earnings are just a little light from what consensus is. And you get shrinkage in the multiple, earnings a little lighter because the economy is a little slower, inflation's a little higher. And then you get a 12%, kind of pullback in the market. And then we sign a very low probability to a pessimistic scenario of 3,300, where you just really get inflation that is much more painful than we think. And you do get a harder landing than we think. And your earnings are lighter and your multiples even lower. You get on a 15, 14, 15 PE and you get lighter earnings. But you can see we put 70% probability. We think it's very likely that we're at 4,800 or above. And that's where we're leaning and how we're positioned. So I think a pretty good scenario. And, look at GDP. We're saying, we're like everybody else, we're not saying GDP growth is going to be 3%. We're saying it's going to be in a range of maybe slightly negative to positive. And that, the Fed's going to stop maybe no higher than 5.75 in Federal Reserve rates, because there's so much evidence that inflation's calming. So that's it in a nutshell.
I thought maybe you were going to upgrade your optimistic case to the 5,500 level that you originally quoted when we kicked off the call.
I was tempted.
Maybe next time. Okay, so moving forward, I do want to give a kudos to the equity team for keeping such a positive tone during the significant pessimism that we were seeing in the headlines and in the media. And as we've discussed, it has been our assessment of the fundamental data, the valuation levels, and the technical price trends, or the FBTs as we call them for short, that you see here on the screen, that have provided the conviction to do that. Can you quickly give a review of this page for those that have joined us today?
I sure can. And as you know, this is what we call our yoga chart, because it calms us in most environments. And, when you get nervous and, all of a sudden maybe you're overstretching in your yoga or something, you'd see a lot of red on here before we would get bearish and defensive and concerned. And you just don't see red. You see yellow and green, mostly yellow. Yellow means neutral. And, I can go through these 3 levels of analysis where we rate each one. Fundamentals, overall, we rate them neutral. You see all the factors that we look at that make up our fundamental metrics: economic trends, earning trends, Federal Reserve policy, trends in rates, credit spreads, so on and so forth. Then valuation, various measures of valuation. We assign them neutral, and technical price trends are neutral. The bearish camp says, oh, they're all negative. We're going to have a recession. The economy is going to really slow down, that earnings are going to collapse. Federal Reserve is going to hike to the moon. And that's, if all that were true, it'd be red, 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 red. And it simply isn't. On the economy, for every negative you give me, I'll give you a positive. And I actually think that this should tilt. We're conservative and rate it neutral. I could make it neutral positive. So some of the examples of that: employment at 3.5% is near record lows. Consumer spending has continued to be very strong. Yeah, we're lightening up in goods, but we're spending on services like crazy. We're actually flying and eating out at restaurants at levels above pre-pandemic levels. Yeah, okay, residential housing is soft within the economy, but multifamily's on fire, and non-residential is hitting all-time highs. There's all this capital spending that's going on. So I could go on and on and on about the economy, and we may have had rolling recessions, for example, in residential housing, but we've got booms in other areas. So overall, okay, let's give it a neutral. Earnings trends, the bearish camp said we're going to get, a 20, 30% decline in earnings. Earnings are probably going to be positive this year. They've been very slightly negative in the first quarter. They might be flattish in the second quarter, and then we look for positive. Margins are holding up and they're stabilizing. So earnings are not collapsing. The Federal Reserve is in its 9th inning. And you know what? We've just gone back to normal. That's all we've done. What was abnormal was what we had before. So I give it neutral, and we say neutral negative because their rhetoric and their speeches are so negative that it scares people. But it's neutral at worst, I would say. Real rates are still very low. So after inflation, cost of borrowing is low. Credit spreads are tight, which means people are confident that their corporate bonds are going to not default. And normally in a recession environment, they're stretching out, and that would be a negative. So fundamentals are neutral. At this point in time, the valuation, as I just mentioned, you got the Meg 8 versus the rest. But overall, we're right on 5 and 10-year averages on PEs. And technically, you've got the number of stocks versus advancing versus declining. at, kind of normal neutral levels, and the number of stocks trading above their 200-day moving average has been coming up from weak levels to neutral. Sentiment, yeah, people become more bullish as the market's, interestingly, as the market has rallied. They were very bearish when it was low, which happens often. That's actually a good thing when people are bearish, because normally people are wrong. And at this point, we haven't gone to over greedy and over positive. We're just kind of neutral. And so, we're neutral. And the thing is, neutral is better than fear. And most of the time, these factors are neutral. And that's why we're neutral in our asset allocation.
So you bring up a good point there, Jeff, and a question that's probably on the minds of many that are listening. If the FVTs have remained constructive, why have we maintained a hold your ground kind of neutral view on the market rather than suggesting increased stock exposure or buying on the dips kind of message? And then secondarily, what would get us to take an even more positive tone about stocks? If you could talk a little bit more to that, I think it'd be helpful.
Yeah, I have gotten that question, and we have, as a team, quite a bit. Jeff, why aren't you buying the dips? Why aren't you, go for it? And I will tell you right now that, we didn't know what the path would be. We didn't know if it would be 3 yards in a cloud of dust, if it would be, we'd see 3,300 before we saw 4,500, and there would just be back and forth volatility. And as I said, we've been surprised by how, quickly we've just kind of gone to where we have gone, even though that was our target. And what I would say is, I understand we think the rally's real, but you don't want to get over positive and uber positive when the fundamentals, the valuation, the technicals are neutral. And they are neutral most of the time. Sometimes we get in extreme environments. Sometimes it's extremely positive. And I'll give you examples of when we were uber bullish. December 2018, the market's trading at 14 times. It was down 20% in the month of December because people thought the trade rhetoric was going to take us into a recession. And we just didn't see it. GDP growth was really positive. We had tax cuts. We had great earnings. It was a beautiful thing from a fundamental standpoint, and valuation was uber cheap. That was an easy call to say, hey, buy on the dip, let's go. March of 2020, we felt the same thing. People were saying, this economic shutdown is going to kill us. The federal fiscal stimulus was going to carry us through the economy, and we knew it was a forced shutdown, not a real thing. And as soon as people realized we could get through it because of stimulus, hey, we're back, to having to produce this stuff with strong demand and people still at work. That was another time where in March of 2020, market fell 35%. Valuation got very attractive. Fundamentals were still just fine on a sustained basis, and we were uber bullish. 2008 was a great example of being uber bearish and going to that low end of your allocation or becoming more defensive. And that's because all this stuff would have been red. You're having a major recession. It was called the Great Recession, and economic trends were horrible. Earnings trends were horrible. The Federal Reserve had hiked, and now it was, oh my God, we got to cut. It was just not good. And your technicals looked horrible. But those are rare occasions. They're so rare. Most of the time, it looks like this. And my answer is, when would you become bullish again? When you saw plus. And we don't. We see yellow circle, yellow circle, yellow circle. So as long as we see that, we're going to be more neutrally postured, feeling that the longer term's fine. But we could have a little bit of a pullback here after a run before we go to that 4,800 that we see over the next 12 months for sure.
Perfect. Thank you.
Sure.
So now let's move to the wall of worry that we monitor. As we like to say, when we really worry is when there is no wall of worry, which, as you alluded a little bit earlier, but which to us would suggest that investors that are at high levels of greed and the last dollar is in, a sizable wall of worry like we see today and in many periods means investors are more, let's just say, level-headed and respectful of the risk items that are out there. And there's plenty of cash that to then come into the market if these worry items are handled well and resolved in a better than worst case fashion. The items on this list, I would say, are not undiscovered and are probably very familiar to everybody on this call. They remain in the headlines. And there are key arguments that are used by the bear camp to suggest that doom and gloom is right around the corner. And I know that we feel that virtually all of these concerns are trending in a better direction, and that this is part of our positive thesis on the direction of the market in the next 12 months. So let's cover these key items, and let's start with inflation, if that sounds good to you.
No, yeah, that's perfect. So if you do flip, there you go. If you flip to this slide, this is something that I think we've shown earlier in the year. And the bear argument on inflation, and those that have been, uber critical of inflation is sticky and it's persistent, it's not transitory, have just kind of said, okay, inflation may be improving and getting less worse, but it's still high. And as a result of it still being high, that's going to be terrible for the market. And I think we all need to be students of history. And we try to be that. And if you study history, and we show here on the top table, the 6 periods post 1950 when inflation has surged. It's gone from some lower level significantly higher. And we list them all, and then we show averages. And so let's just pick on one of them. November of 1974, inflation 16 months prior to November of 74 was 5.74%. And you see that in this column. By November, 16 months later, it surged to 12.2%. 16 months after November of 74, it fell back to 6.06, almost went back to where it was. But the bear or the pessimist would say, well, yeah, Jeff, but it was still high. The long-term average inflation rate's right around 3.5% or so. This is at 6. So I bet you the market just really stunk because it stayed high. And that's what the more bearish camp is arguing. It's improving, but not quickly enough, and it's not going low enough. Well, let's look below and let's see what happened in the 12 months after inflation peaked at 12.2%. And it only went back to 6, but it peaked at 12 and it got less worse. What did the market do in that period where it fell but still remained high? The market was up 30%, as you see in that column second from the right on the table below. And on average, the market's up in nice double-digit territory in all of these surging inflationary periods in the 12 months after it peaks. So it just needs to peak, and it's peaked. We've got CPI that has gone from 9.1% headline to around 3% now. I don't think people realize that. Year over year, CPI has fallen back down to 3% year over year. Core, if you exclude food and energy, is still at 4.8%, but that's down from well over 6 where it was. But the point is, it's peaked and come down, and look what the market's done. And that just is not a surprise to us. And I'll give you an analogy real quick. People are sick and tired of hearing about me renovating my house, but it's been a big deal. It's been going on for 14 months, and we've had a lot of headaches about it. And I've been stressed, and I haven't been able to work out like I normally do and run and play tennis and all that stuff. I've been lifting boxes and yelling at contractors, firing contractors, and I've gotten little education over what that's like. And I bet a lot of people on this call know what it's like. But you know what? We did move forward, and we had good resolution. We peaked in terms of effort and stress with that house renovation, and now it's calmer. There's still a challenge, but it's calmer. and I'm running and playing tennis and having a good time again and doing this crystal ball with y'all. And that's all, man. Our moods get better. And we start doing normal stuff like buying stocks. And we don't worry so much. And so it's not perfect, but it's way better than it was. And that's all that has to happen here in the market. And if you're a student of history, that's what happens. So if we go to the next slide, Katrina, this boy, look at that wave. We got an alphabet soup up here of different types of inflation, and we got color codes all over the place. You got CPI, core, and regular or headline. We got PCE, the personal consumption expenditure index that the Fed follows, in the yellow and the green. We got the producer price index, the PPI, headline and core. But notice there's something consistent among all of them. They peaked and they're coming down consistently. And I want to pick on just a couple of them. If we look at, for example, let's look at CPI. And I want to update you. This is actually May's data at 4% year over year, CPI in that center column. The peak at 9.1%. Well, the June number's 3%. So we have taken 6% off from the peak. That is huge. And if you look at the PPI, which is a leading indicator, the producer price index, which is the cost of materials and raw materials and inputs to make final goods, PPI is now down to 1.2%. CPI should follow, unless companies get too greedy and say, whoa, these margins are outstanding, I'm going to gouge people. And I don't think they're going to do that. So, all these things are moving in the right direction. And that's consistent with our thesis that, hey guys, things are getting better. It's not going to happen overnight. You want instant gratification, that won't happen, but it's moving in a good way. And then the next slide gets at rents. And this is really a goofy thing. We think that inflation is well overstated and that the trend is unappreciated in terms of calming. The red line shows you what rents did from 2019 to through the present. They went from somewhere around, let's call it $1,350 a month, the median rent, to $1,750. Wow, that's a big line. And then you get the year over year percentage change in rents in that gray line. And you can see it speaks up. They were increasing at a 16% year over year rate earlier. Now they're actually in decline. So they've peaked and they've started to come down, and that's real rent. What goes into CPI and what keeps it sticky is there's this magical make-believe fictitious number called owner equivalent rent. And that's not what, we don't rent our home. We have mortgage payments, we own our home. But what the Fed does is say, well, if you're going to rent your home, what would be a market rate based upon current interest rates and all that stuff? And it's higher, and it's being sticky to come down because rates have kind of stayed up, but that's a fake number. This is what puts money in people's pocketbooks, and rents are starting to come down. And that will lead to inflation falling. So we see trends, positive and calming. And this is why this gave us conviction to feel that the Fed wasn't going to have to take rates up to 7% or something, like the 1970s. I'm not sure if we have another slide. I don't think we have another slide.
No,
we don't.
I wanted to shift to potential policy mistake risks. And so as you think about both government fiscal oriented, as well as what I'd say is the almost obsessive attention being steered about or toward the Federal Reserve and Jerome Powell, what's your take there?
Yeah, so, there's two kinds of policy. One is fiscal policy, and then the other one is monetary policy. And people have been very concerned about mistakes in both of those categories, particularly, as you say, the obsession with the Fed. But it's kind of understandable what the Fed has done. fiscal policy preceded the Fed's action to rise rates. And they had to do what they did. People suggested maybe they should have done it sooner. But you know what? We're none of us are perfect. And it doesn't mean that you can't play catch up and solve an issue. So what we have on this chart shown here is the growth in the money supply, M2. And this really gets at what happened from a fiscal policy standpoint. We had all that helicopter money that was dropped during pandemic. And you know what? We needed to do that. Now, people might argue and say, well, it went on a little too long. And I might agree with that. But, we don't have that happening anymore. And this captures, as they drop that helicopter money, the money supply, which normally grows in sync with GDP in that kind of 2 to 3% range, in a band that's a little wider than that, but that's normally on average where it should grow, and it has done that historically. It shot up. You can see on the far right how money supply grew by 30%, unprecedented. Going back, never seen that, because we were trying to save the world from COVID. Well, that puts a lot of pressure, particularly when you're stuffed in your home and you can't go out to restaurants. Man, you're going to redo your home and your swimming pool, and you're going to buy electronics and all that stuff. And that drove inflation, particularly when you couldn't make enough of the stuff and you had to wait 3 months to get it, or 6 months or whatever. Everything was on back order. And so that drove inflation, and that forced the Fed's hand in a big way to start rising rates to slow down demand. And guess what? Look at what M2's done. As a result, it has come down. And I was an econ major, and people will complain about M2 isn't what it used to do, but there is a cause and effect and a correlation between coming down. Now, the Fed should note that money supply growth is going negative. And I think they will take note of this, and it will allow them to be aware and maybe say enough is enough. We're going to talk tough, but enough is enough. So I actually think what the Fed has done makes sense. I think what the government did made sense. We just went a little bit maybe too far, and I don't want to judge. I just know that things are moving in a better direction. Stimulus is less, and so is accommodation. And if we look at the next slide, Katrina, I think, again, for all, everything's so negative. Everybody goes negative. Oh, what the Fed has done is unprecedented. It's terrible. My God, they've hiked rates, and we're going to end up in a really bad place. I would say, well, hold on. What have they done? This shows you the average or the median Fed funds rate over going all the way back to, the 70s. And you can see the horrible kind of 70s period and early 80s, where Fed funds rates were 20%. That was unprecedented back then. That was crazy. And the other period that was crazy was when we went to zero to bring us out of, that was to squelch crazy inflation levels back then, as oil embargoes were in play, and we had cost of living hikes and union, contracts and that kind of thing. And now, we fast forward 2007 and 2008, and we were trying to avoid breadlines as unemployment spiked to 10% during the housing implosion. So those were crazy, unprecedented periods. What has the Fed done? The Fed's taken us back to about 5.25% in rates. That's normal. That's average. And so I think we need to chill for just a minute. Isn't that what we want? I want mom to be able to go to the National Exemplars as opposed to Bob Evans. And, feel like occasionally she might be able to go to the Cincinnati Symphony Orchestra or something, because she's making 5% on her portfolio. And so I think that we've just kind of gone to normal. We could overshoot a little bit, but I don't think if we overshoot, it will be by much, and certainly not enough to cause a really hard landing scenario. We reserve the right to change our mind if things change, but that's kind of how we view policy. And we understand it and think it's okay.
No, I think this is a great chart. I mean, when you have rates that low for a decade, people forget that they used to be
Right,
higher from a historical average perspective.
right, right.
So Jeff, update us on the risk of recession and a potential collapse in earnings that has consistently been a major concern of stock market skeptics during 2022 and 2023. We've long been in the softer landing camp. So if
Yes.
you could explain more around that, that'd be great.
Yes. So, one of the things that the more skeptical folks have said is, Jeff, Katrina, in a recession scenario, we've got a lot more downside in the S&P 500. And they cite data in this table to support that. And what they say is, hey, in a, hard landing or in an average, they'll say in an average recession, the market's down almost 40%. You see the 39.4%. That is the average decline looking at all recessions, depressions over time. But we think it's not wise to look at that number to judge the downside, because included in that average number is 1929 and 1937, when the market fell 86% and 60%. And look at that time to recapture new highs. It took 267 months, which if you calculate that out, that's 22 years. I think that it's really not realistic to think that it's going to take 22 years for us to recapture the high in the S&P 500. It also includes the periods in 73 and 2000, 2007, when the market fell, 50% plus. It took months to recover. And we had a true implosion. We had 20% unemployment back in the 30s. We had 10% unemployment in 2007. We got 3.5% unemployment now. If you X out those crazy, terrible periods that we're not close to when looking at the economic data, the average decline in a quote recession is somewhere around 25%. And that's what we were down last year in anticipation of a recession this year, which has not happened and may not happen. So that gives us comfort that there's not significant additional downside, even if we do have a recession. And by the way, half of the time the market's up in the midst of recession after it finally happens. So that's part of my answer, saying this is where we're comfortable with market levels, even should the economy slow. And the other bearish argument is on the next slide. For those that want to be really skeptical, they'll say, hey, Jeff, okay, earnings haven't even gone negative yet. And if they do go negative, then the market is just going to be horrible. Well, this looks at this chart, again, as students of history, it looks at the 11 occasions in which we've had more than a 10% decline in earnings since 1950. The blue bar shows you the decline in earnings in those various years that are designated. The red line shows you the result in the S&P 500. In 9 of the 11 years, the market actually had strong double-digit returns, despite the fact, or they had positive return, despite the fact that you had negative earnings. It was only in 2001 and 2008, those were 30-year flood events, the tech bubble where things exploded, and the housing implosion, the Great Recession, where the market didn't react positively. And that's because most of the time, the market anticipates recession. It moves in advance of the potential earnings collapse, as it did last year, falling 25% peak to trough. And now we're in the phase where the market will move forward as it did in all these periods. And after the earnings went negative, it starts anticipating, or as they were going negative, it anticipates recovery in the following year, and it moves in advance. So we think we're kind of out of the woods, if you will, in terms of this argument, because we don't even see earnings falling significantly. Margins are starting to trend back up. So that's a good thing. And the final kind of discussion on this is to support that fact. Look at the trend in earnings. In 2023, beginning in spring of last year, consensus was that we would make just shy of 250 in 2023 earnings, and they fell to the 220 level, but they stayed pretty consistent. They stabilized. Same thing can be said for 24, and then in 25 they're starting to move back up. So we're seeing a stabilization in trend, and part of this is because margins on the far right, you can see where they shot up and they peaked, and then they fell and they started to stabilize. And when you get the producer price index increasing at 1%, but CPI is growing at north of 4%, that's good for margins. It's also good for wage growth. When you see wages growing 4%, and inflation, if you look at, CPI only at 3%, that means our after inflation spending and disposable income is higher. So that's all good for earnings, and that's how we view the positive trend versus this uber negative thought that we're going to have a collapse in earnings and a horrible recession. There's way more downside of the market. We just didn't see it.
And then I think, did you want to comment on capital spending also?
I did. I think this is the big surprise. Again, for every negative in the economy that you want to throw at me, I'll throw you an offsetting positive. And one of the real surprises this year, it's not even talked about that much, is the re-onshoring in the U.S. and spending on plant and equipment that is on fire. And so capital spending is a real surprise this year. And this shows the various types on this chart of capital spending. And I'm going to look at my hard copy here real quick. Look at non-residential spending, which is a far higher in amount than on residential. These are measured in trillions of dollars. And so you've got a 10% increase in non-residential spending as we re-onshore, and as we in Cincinnati, Ohio, are building bridges here so we don't fall in the Ohio River. We're going to spend $3.5 billion in Ohio, and we haven't been able to do that for 20 years. And that's because the leadership in Washington, good or bad, however you come down on that, they've passed 3 bills that spend on infrastructure like crazy. And so construction employment is moving to all-time highs. And you see construction in place on the far right, and you've got, in terms of non-residential in the green, hitting all-time highs, man. It's on fire. And so you may be crabby about residential or something like that, but there's a real capital spending boom. That's part of the reason why we love stocks like United Rental, why we bought a number of industrial stocks of late, and some in the material space, the Vulcans of the world, so on and so forth. We think there's real opportunity. So this is a positive that I think is unappreciated.
Yeah, no, thank you for walking through all of those. I want to shift gears and go back to the market narrowness that we've both commented on throughout the comments today. And one of the bear arguments and a major concern that they've expressed is that S&P 500 returns have been led by a narrow list of less than 10 stocks, which we're all now calling the Mega 8. And that without them, stock returns would not be excellent this year, but instead would be absent. And I know that you have a different perspective on this, so I thought it'd be great if you could discuss that point.
Yeah, and we could show a number of different charts and graphs on this. This happens to show what the S&P 500 equal weighted index is, how it's performed relative to what's called the market cap weighted index. And so the equal weighted says we got 500 stocks ish, we got a little more than 500 actually in the S&P 500. But if you equal weighted them and had the same weights in each stock, what would your return have been versus, I'm going to say Apple and Microsoft. I could be wrong on this, but I think there's something like 8 or 9% of the S&P 500. And so if you take, the weighted return, then because of the mega 8 that have done so well, for the longest time, the equal weight was underperforming. That's begun to reverse course. And you can see that. And that has given us confidence that this has begun to stabilize. So that's a good thing. I'll tell you from just a practical standpoint, and we have, currently 4 different internally managed equity strategies, and they each have a different purpose. One of them is more aggressive in nature, and it's outperformed the S&P 500 by about 400 basis points so far this year, a little more than that. And we only equally own most of the names in the mega 8, or we own less than. And despite that, we've outperformed by 400 basis points because there are so many stocks and in consumer discretionary and in technology that we've really liked. And I guess for compliance purposes, I'm not going to mention them, but there's a number of them that we've owned. They're up 40, 50, 100%, and they're not mega 8. So I know from selection, you can do this, and there are a number of industry groups that have outperformed. And so it's not like you got 8 going up and the other 492 are going down like the world is suggesting. And you can see the trend also in broadening the market in this next chart. And I think it's important. This shows you the percent of stocks trading above the 200-day moving average and the top chart, or 50-day in the top chart and the 200-day in the bottom chart. And it is true when you look at this that earlier in the year, you only had 20% or so of the stocks in the S&P 500 trading above their 50-day moving average. Now you have more like 65%. And you have 60% in it trading above their 200-day moving average. So that's a nice trend. And so a number of stocks are moving at this point. And that's part of our confidence in sitting there and saying, hey, we see 4,800 over the next 12 months. You got more participation. And that is a very, positive sign. This gets at valuation, and I did want to separate this out again. And it speaks to the influence of the narrowness of the market. And here I just wanted to show people the price to earnings ratio on the mega cap 8 at 30.6. If you X those out, the S&P 500 is trading at about 16.4 times. And overall, the S&P is trading at 19 times. So it's not as expensive as advertised, and it's heavily influenced by just a handful of names. There are a lot of stocks out there trading at below their 5 and 10-year averages and below the market 5 and 10-year average. So, I think it's over advertised that, the market's just super expensive. We don't view it that way.
Yeah. Well, Jeff, with just a few minutes left, what words of wisdom and takeaways do you want to leave our audience with?
Well, for the technically inclined, if you look at, some of the, more nerdish kind of technical stuff, look at our yoga chart. And I just say yellow and green is good, red is bad. So don't forget that. This is what we look at. We try and keep our eye on the prize, not what the headlines say, but what the data says. And I think it keeps us sober, respectful, and not optimistic, but objective. And that's what we try and do in our process. And then we got, everybody's got little pearls of wisdom. And we like to say the following: don't predict the predictors. So many people out there want to make a name for themselves. And there's a graveyard of chief investment strategists and chief investment officers who've tried to predict the predictors. We look at the data and notice the trends. So I don't predict where inflation's going. We look at what the trend is, and it's coming down. And so, we then take our read and listen from the data. You got to be patient. You're not going to get instant gratification. And if the yoga chart is yellow and green and the world's crabby, that to us says opportunity. So be patient. Continue to hold your ground. Don't get uber bullish and don't get uber bearish, because the charts are yellow and green. They're neutral. So maintain your, kind of sense of reality. and maintain a blend of growth and value. No reason to go to extremes. Do you think that cybersecurity and the need for productivity driving software is going to go away? Do you think the trend towards green technology is going to go away, which is in that growth area? We don't. So why would you run to value in an extreme sense? It doesn't make sense to us. Long duration growth stocks are not dead. We think active management through good stock selection can add value when you got some of the market trading at 30 and some trading at 16. There's opportunity over here. And then, if you care about my mother, cheer Harriet Krumpelman on, with bonds. They give you a good rate and some good income generation. And, I wouldn't forget small caps and an opportunistic, portfolio, as the valuation is very attractive. And they do tend to be more value oriented in the financials area and the industrials area and so on and so forth. So these are just little, tenets that keep in mind, through the balance of the year.
Well, I think that's officially a wrap for our mid-year review and the outlook for the remainder of 2023. Thought that was great. I want to, Jeff, thank you for participating in the discussion with me today. To all those listening and tuning in, we just want to thank you for joining. We hope that you found today's discussion helpful. We appreciate your confidence and, of course, the opportunity to serve you. We hope you enjoy the rest of your summer and wish you a prosperous second half of 2023. We'll see you in January.
Take care, everybody.